All right, let's talk EPR Properties. We're diving into their Q2 2025 earnings call, and boy, it was a mixed bag. On one hand, you've got some really solid growth, but on the other, a miss that really spooked the market. So what's going on here? We're going to unpack it.
So here's the headline that caused all the stir. You've got revenue beating what the analysts were expecting, which is great, right? But then you look at FFO, that's funds from operations, a super important number for any REIT, and it came in just a hair short of the target, a real head-scratcher.
And you know how the market is? It did not like that uncertainty one bit. The stock took a hit, down almost 3% on the day, and a lot of shares traded hands. So the big question is, what's really driving this? Why did that small miss overshadow the revenue beat? Let's dig in.
Okay. But this is where it gets really interesting. If you peel back that one little FFO miss, the rest of the picture looks pretty good. I mean, revenue is up, their adjusted FFO is growing nicely, and just look at that GAAP earnings per share number, a 78% jump. That's huge. It tells you the core business is chugging along. So clearly, Wall Street's got its eyes on something else.
And that something else is really the heart of the story here. It's this classic tug-of-war between a single quarter's numbers and the bigger long-term picture management is painting. They've got this strategy they call the recycle to upgrade playbook. And honestly, everything revolves around that right now.
Yeah, and the CEO, Greg Silvers, he got right on the front foot with this. On the call, he kept coming back to their disciplined approach to capital allocation. That CEO speak for, hey, don't worry about the small stuff, we're making smart moves for the future. It's all about upgrading the quality of what they own.
So what is this playbook? It's actually pretty straightforward. Step 1, sell the old stuff, mostly the underperforming movie theaters that are kind of dragging them down. Step 2, take that cash. And step 3, use it to buy new, exciting properties, what they call experiential assets that are going to give them a much better bang for their buck.
And bam, here's the result. Look at this. The portfolio is now overwhelmingly dominated by these experiential properties, 94%. This is no accident, folks. This is a massive, deliberate pivot away from the past and straight towards where they think people are going to be spending their money in the future.
And it's not like they're just buying more ski resorts or whatever. They're branching out into some really cool new areas. We're talking traditional golf, these eat-and-play spots like Pinstack, and they seem super excited about the whole fitness and wellness trend, especially with assets like their hot springs attractions. Pretty diverse stuff.
All right, so that's the strategy. But what are they actually promising Wall Street? Let's get into the guidance and what the analysts were really grilling them on.
Okay, this is probably the most important slide when it comes to their outlook. Notice, they kept their main earnings guidance the same, no surprises there. But look at disposition proceeds. They jacked up their target for how much stuff they plan to sell. That's a huge signal. It tells you they're confident they can find buyers and really accelerate that recycling plan.
Now, one thing that definitely got analysts' attention was this new ATM program. An at-the-market program basically lets them sell new shares into the market whenever they want, a little at a time. It's a flexible way to raise cash. Now, management was very clear. This is just about having options. They said, don't panic. We're not planning on selling any shares this year.
And you can't talk about EPR without talking about the movies. The box office continues to be a wild card, but a positive one lately. Just look at that year-over-year jump, up a whopping 37%. Why does this matter for a real estate company? Well, a lot of their theater leases give them a slice of the ticket sales. So when the box office is booming, so is EPR's cash flow. It's that simple.
So what did the analysts want to know? Well, the Q&A session basically boiled down to a few key pressure points.
Yep, they were really focused. First, it was all about the money, the balance sheet, that ATM program, maybe a new bond offering. Then they hammered on the box office, asking, is this for real or just a temporary blip? They also wanted to know if EPR is ready to start making some bigger moves, like $100 million plus deals. And finally, there was a lot of curiosity about the change in leadership for their investment team, which is a pretty big deal given their strategy.
Okay, so let's put all the pieces together and do what we do best. Make a call on what happens next. When they report next quarter, there are really only two things you need to watch. These two metrics are going to tell the whole story.
So here's our prediction. First, the metrics to watch. Keep your eyes glued to their progress on asset sales. Are they hitting that new, higher guidance? And second, watch those percentage rents from the box office. Are they still strong? As for the stock, we think it's probably going to be stuck in a range for a while. You've got this great story about strategic recycling on one side, but on the other, you still have this lingering doubt about the future of movie theaters. It's a classic standoff. That's why we're giving it a market perform rating.
And of course, we have to say it, this is just our analysis for informational purposes. It is not financial advice.